All right, welcome to Talkin' Investing. I'm Tom, and as always, this is not financial advice. Today, I want to talk to you guys about Volta. They are an EV charging station, stock ticker VLTA. We've talked about these guys on the channel in the past. I did do a video in June, so we'll revisit what I talked about in that video and update that information as well because some major things have happened since then. So if you're new to the channel, remember to subscribe and hit the notification bell. Also, if everybody could please smash the like button, it really helps out the channel a lot. In addition to that, if you want to support the channel, you can hit the join button. By joining, you become a member of the channel, and that's right on the YouTube page. So there's some members only content. In addition to that, we have a members only live stream every Tuesday after the market closes. So that's actually today if you happen to be watching this video the day it's posted. Okay, so let's go through Volta. Volta right now is sitting at $1.06. So this is very near its 52-week low. If we look at its 52-week low, 98.4 cents was its 52-week low. This has been as high as $12.98. So you can see this stock is down dramatically over the course of the last year. So we're going to go through the charts later. Volta did just hit that 52-week low, which is their all-time low, just a few days ago. So they're just coming off of that right now. This leaves them with a $179 million market cap. I just want to put that in perspective. So I like to go to this chart, which measures their market cap over the last year. So you'll see as recently as January of 2022. So, you know, that's over 9 months ago, but that is within the 52-week window time frame. This was a $1.28 billion company. So they have lost a monumental amount of market cap over the course of the year 2022. So I'm just going to show you one more number. You'll see back in August, the market had a little bit of a run up. And this company got back to almost a $500 million, $490 million company. Okay, so the focus of the video that I did in June was that I felt that the risk profile on this stock had changed. And again, please remember, this is not financial advice. You guys need to do your own due diligence. So I'm not telling you to buy or sell this, but I am going to tell you whether or not I bought or sold this. The gist of my June video was that I thought the risk profile had changed for the worse, and there was potentially some more downside risk to this company. So the stock is actually down quite a bit from that video. However, it did have a nice run up in the middle, so we'll go through that later. Their June 30th quarterly report came out, and they added this to their footnotes in the financial statements. If the company is unable to raise additional capital, the company will need to significantly curtail its operations, modify strategic plans, and/or dispose of certain operations or assets. Okay, so obviously this is a significant thing to say in your financial statements. I do want to let you know this is not an automatic death sentence to a company. There are many companies that have had to address liquidity and going concern. There are many companies that have gone through periods of doubt as to whether they can get through the next year. So plenty of these companies have made it through. However, some of these companies do not make it through. This is a gigantic red flag. So again, it's not a death sentence, but it is a big red flag. And this was exactly what I was concerned about when I made my June video. The most important part of that was if the company does not raise the additional capital, it is unlikely the financial requirements will be met. So that is very significant. So they're telling you they need to raise capital and they have doubt as to whether or not they will do that. So that is the number one thing we need to be keeping our eye on. Can they raise capital and avoid this situation? Okay, I just want to take a quick look at the balance sheet, the income statement, and the statement of cash flows, because that's really what's going on here. We need to keep our eye on that statement of cash flows. So for those of you who are familiar with the channel, you know I like to look at the current ratio, which is the current assets versus current liabilities. Now, we remember that there's also $16 million of long-term liabilities that they may have to reclassify as current if they are outside of the covenants of their note. But right now, as it sits, they have total current assets of $148 million, and they have total current liabilities of $104 million. So at the moment, that ratio is decent. However, the problem comes in when you look at their statement of cash flows. And I want to talk a little bit about what this business does before I do that so that you can understand why it's such a cash-intensive business. Volta does not sell their charging stations. Volta is essentially a media company. They have EV charging stations, but their main source of revenue is for the advertising that comes from these charging stations. These tend to be in parking lots and highly visible from the street. So this is an advertising venue. So while its core principle is to charge your car, their core revenue model is the revenue that they get from these advertisers. So because of that, essentially, Volta actually owns all of these charging stations. So however many charging stations they end up putting in, they own them. So they need the revenue to pay for themselves. And it looks like the formula for that is is good. And ultimately, these machines pay for themselves reasonably quickly, over the course of a few years. In order for them to continue to grow, they need to continue to install new EV charging stations. So that is very capital intensive. And right now, as everybody knows, this is not a market where it's easy to raise capital. Raising debt is getting harder and harder. And when your stock is down so drastically like it is, raising equity at this point is an absolute last resort. Their stock is down to $1. So they really don't want to be raising huge amounts of equity. That's going to cause huge dilution. Of course, they would do that if they have to versus going out of business, but that is a last resort situation. I'm going to go right to the statement of cash flows because there's just two numbers on here that jump out, and this is the problem that they are having right now. Now, under different circumstances, in a different market where liquidity is more available, this company could potentially be thriving, and that's what was happening earlier this year and last year with the price of their stock. 2 years ago, capital was easy to come by. Small cap, high growth stocks were thriving. It was a risk on environment, and this company would have been in great shape. However, we are at the absolute opposite end of the spectrum right now. We are in total risk off environment. So that does put a strain on their ability to raise the capital that they need. And if you look, so from operations, they lost $74 million of cash flow. So this is a negative cash flow company operationally because they are still early stages and they just haven't built themselves out enough to be positive cash flow from operations. So they're a few years away from that. In addition to the fact that they have a cash burn rate from operations, you'll see the next section is called cash flow from investing activities. This is why they added that liquidity conversation to the footnotes in the most recent financial statements. So because of that, I was already very concerned about this company. I put a video out that said the risk profile had changed. So this really confirmed what my deep fears were. So I'm still in a situation where I'm saying, I think this is a very high risk company. I like this company. I love what they do. In any other market, I think they would be having no problem at all. The other side of the coin is this is an EV charging station. So the government is going to subsidize some of what they do. There's a lot of money out there for this, and there's only a few players in this game. So for those reasons, I do think they have a very legitimate chance of getting to the other side of this problem. They are staring a big problem in the face right now, and they have to get through that. Their stock is paying for it greatly. Okay, so if I'm zoomed out on the 1 week time frame, for those of you who watch the channel, you'll know that January, February of 2021, small cap, high growth stocks spiraled to the upside, so I tend to completely discount this and not consider it when looking at pricing. But this stock's down almost 92% from November. So you can see this stock's been taken out dramatically, and we saw that in the market cap. I want to zoom in a little bit and talk to you about what I did with this stock. This line starts right here on June 15th. This is when I made my previous video, and at the time that I made my video, this stock was trading at $1.56. I was concerned the risk profile had changed and there was more downside to come in this stock. Well, it did pull back a little, but then the market itself went on basically a month and a half very strong rally. So the high growth stocks participated in that rally, and this got all the way back up over $3. That was on August 15th, and that really marked the end of the relief rally for the market. So the stock pulled back greatly. We got one other run up. So I will tell you, I sold my shares of the stock after that report came out about a month later on September 14th at $2.34. I felt like this was about the last chance to get out. I did miss it by a day because you'll see there was a big run up the next day. I could have gone as high as $2.58, but I feel okay with that because if you look at what's happened to the stock since then, from the time I sold it to where it's trading right now intraday, the stock's down 54%. So this stock has been beaten down badly. It's down about 30% from the time I did my last video. So I feel good that I was able to make up. I did catch essentially a 50% run up in this stock from the time that I made that video and said that I was concerned until the time I sold it. I was planning on holding on to this because I assumed it was going to continue to trickle down. But with 50% move to the upside, I did sell it at that point. I feel like the red flag I called out back in June ended up playing out exactly the way I thought it would. The one thing I did not see coming was a nice relief rally. So that did give me an opportunity to exit this stock. The stock is getting interesting to me down here at $1. This is way down from where it was when it was already significantly beaten down. I'm not ready to buy back into this stock yet. I would like to see them get some financing. I may miss my window of opportunity to get back into this stock. But until they've solved this liquidity problem, there's just too many other stocks that are selling at a huge discount that I would rather be involved in. So I like this company. I've always liked this company. I do still hold out hope that they're going to be a big success over the long term, but in the short term, I am staying away from the stock. Again, that's not financial advice. You guys need to do your own due diligence and decide whether or not this meets your risk-reward profile. So that's my update on Volta. If anything significant happens with these guys, mainly if they're able to raise some capital, I will do another video and give you guys an update on what's going on. Remember to subscribe to the channel and smash the like button. So thanks again, and I'll see you in the next video.